A transformation is occurring in the global financial system that most people cannot see. While headlines focus on trade wars, inflation rates, and stock market movements, a far more fundamental shift is taking place in the architecture of international commerce. China's digital yuan initiative represents more than technological innovation or monetary policy experimentation. It constitutes the foundation of an alternative financial system designed to operate independently from dollar-dominated networks that have controlled global commerce for over 7 decades. Understanding this transformation requires examining how reserve currency systems actually function and why they eventually change. The United States dollar achieved global reserve status through a combination of economic dominance, military power, and institutional arrangements established after World War II. These arrangements created systematic advantages that allowed the United States to finance government spending, military operations, and economic development through international dollar demand that exceeded domestic economic activity. However, reserve currency status also creates inherent vulnerabilities that intensify over time. Countries holding reserve currency status tend to develop trade deficits, accumulate unsustainable debt levels, and implement monetary policies that serve domestic political needs rather than international stability requirements. These imbalances eventually undermine confidence in reserve currency sustainability, encouraging alternative arrangements that reduce dependence on any single national currency. The mathematics of United States debt obligations illustrate why current arrangements have become unsustainable. Total debt obligations, including federal government debt, state and local government debt, corporate debt, and household debt, exceed $318 trillion when including unfunded liabilities for Social Security, Medicare, and government pension obligations. This figure represents over 15 times annual gross domestic product, ratios that have never been sustained throughout history without currency devaluation or system restructuring. Federal government debt service costs now exceed $1 trillion annually, representing larger budget categories than defense spending, education funding, or most other discretionary programs. These interest costs increase automatically as existing debt matures and requires refinancing at current market rates that substantially exceed rates on debt issued during previous decades of monetary accommodation. The compounding effect creates debt service growth that exceeds economic growth regardless of new spending programs or policy initiatives. China's digital yuan development occurs within this context of dollar system mathematical unsustainability. Rather than directly challenging dollar hegemony through confrontational policies, China has methodically developed technological and institutional capabilities that enable international commerce without dollar participation. The digital yuan provides real-time settlement capabilities, programmable payment features, and direct central bank issuance that eliminates intermediary banking requirements for international transactions. The technological advantages of digital currency systems extend beyond simple payment processing to include trade finance, supply chain management, and cross-border investment facilitation. Digital yuan transactions can incorporate smart contracts that automatically execute complex trade arrangements, reducing counterparty risks and transaction costs that currently require dollar-denominated banking services. These capabilities make digital yuan attractive to trading partners regardless of political considerations about dollar dependence. More significantly, digital yuan adoption creates network effects that strengthen with increased usage. Each additional country or institution accepting digital yuan payments makes the system more valuable for existing users while reducing reliance on dollar-based alternatives. This network expansion operates independently from Chinese government promotion, as commercial advantages encourage voluntary adoption by businesses seeking more efficient international payment mechanisms. Central bank behavior worldwide provides clear evidence of systematic movement away from dollar-dominated reserve arrangements. Official sector gold purchases have reached record levels while central bank dollar reserve reductions accelerate simultaneously. This pattern reflects institutional recognition that monetary system diversification requires alternative assets that maintain value independently from any single country's fiscal and monetary policies. The coordination evident in central bank behavior suggests systematic planning rather than coincidental policy alignment. Countries representing over 40% of global economic output have announced or implemented bilateral trading arrangements that bypass dollar settlement mechanisms. These arrangements utilize various approaches, including direct currency exchange, gold settlement systems, commodity-backed payment units, and digital currency frameworks that all reduce dollar transaction requirements. Russia and China have developed extensive bilateral trade settlement mechanisms that process hundreds of billions in annual commerce without dollar participation. India and Russia utilize rupee-ruble arrangements for energy transactions. Saudi Arabia has indicated willingness to accept alternative currencies for oil purchases. Iran and Turkey have implemented gold settlement systems for trade transactions. These bilateral arrangements create precedents and infrastructure for broader international adoption. The European Union's development of SWIFT alternatives and euro-denominated trade settlement mechanisms reflects similar concerns about dollar system vulnerability and desire for monetary sovereignty. European institutions recognize that excessive dependence on dollar-dominated systems creates political and economic risks that require alternative capabilities for financial system resilience and policy independence. Regional development banks and multilateral institutions increasingly utilize non-dollar currencies for lending and project finance activities. Asian Infrastructure Investment Bank, BRICS Development Bank, and regional development institutions all offer financing in local currencies or alternative arrangements that reduce borrowing country dollar exposure while providing lenders with diversified currency portfolios. The gradual nature of this transformation prevents dramatic recognition that might trigger defensive responses from dollar system beneficiaries. Unlike sudden currency crises or dramatic policy announcements, current changes occur through incremental adoption of alternative systems that appear commercially motivated rather than politically coordinated. This gradual approach reduces resistance while building infrastructure that could rapidly expand during crisis conditions. Historical precedent demonstrates how reserve currency transitions typically develop through exactly this type of gradual system replacement rather than sudden abandonment. The British pound's displacement as global reserve currency occurred over several decades through incremental changes in international commerce, central bank reserves, and trade settlement practices. Most observers didn't recognize the transition until it had largely completed, despite clear evidence of systematic change for those monitoring appropriate indicators. The Spanish real, Dutch guilder, and French franc all experienced similar gradual displacement processes where alternative systems developed alongside existing arrangements before eventually superseding them. Each transition reflected mathematical unsustainability of existing arrangements combined with superior alternatives that offered commercial or political advantages to adopting nations. The timeline for current dollar system changes appears to be accelerating based on infrastructure development and adoption rates in alternative payment systems. Digital currency implementation typically requires several years of testing and gradual rollout before achieving operational capacity. China's digital yuan has progressed beyond experimental phases into operational deployment for domestic use with international capabilities under development. Cross-border digital currency testing between China and multiple trading partners indicates systematic preparation for broader international implementation. Pilot programs with Hong Kong, Singapore, Thailand, and United Arab Emirates demonstrate technical feasibility while building operational experience necessary for larger-scale deployment. These pilot programs create the institutional knowledge and technical infrastructure required for rapid expansion during favorable conditions. The debt service mathematics facing the United States create timeline pressure that operates independently from alternative system development. Interest costs that exceeded $1 trillion in 2023 continue growing automatically as existing debt matures and requires refinancing at higher rates. Federal Reserve policy tightening to address inflation increases government borrowing costs while potentially triggering recession conditions that reduce tax revenues and increase social spending obligations. The political impossibility of reducing spending sufficiently to balance budgets without debt service growth creates systematic pressure for monetary accommodation regardless of inflation consequences. Politicians cannot eliminate Social Security, Medicare, defense spending, and other major budget categories without facing electoral defeat. This political constraint means debt service growth continues regardless of economic conditions or policy preferences. Monetary accommodation to address unsustainable debt service costs creates the currency devaluation pressures that encourage international adoption of alternative systems. Countries holding dollar reserves face systematic losses from devaluation while simultaneously developing access to superior alternatives through digital currency and bilateral trading arrangements. The combination creates powerful incentives for reserve diversification and alternative system adoption. Corporate behavior shows increasing recognition of currency transition risks and alternative system opportunities. Multinational companies increasingly utilize local currency trading arrangements, hedge dollar exposure through precious metals positions, and develop operational capabilities in multiple currency systems. These corporate preparations reflect institutional awareness of monetary system changes that haven't yet reached public consciousness. Financial institution positioning reveals similar preparation for monetary system changes through precious metals accumulation, alternative currency trading capabilities, and reduced exposure to dollar-dominated assets. Major banks and investment firms have quietly shifted portfolio allocations while developing operational capabilities for non-dollar international finance. These institutional preparations suggest professional awareness of systematic changes that public policy statements don't acknowledge. The energy sector transition toward alternative currency acceptance represents particularly significant development because energy commerce has provided crucial support for dollar international demand since the 1970s petrodollar arrangements. Saudi Arabia's indication of willingness to accept alternative currencies for oil sales removes automatic dollar demand that has supported United States government financing for decades. Energy transition toward renewable sources reduces long-term oil demand while simultaneously increasing demand for commodities like lithium, copper, and rare earth elements that China dominates through production and processing capabilities. This commodity demand shift strengthens China's trade position while reducing traditional energy exporters' automatic dollar accumulation through oil sales. Supply chain restructuring following pandemic disruptions has accelerated geographic diversification of manufacturing and commerce in ways that reduce automatic dollar usage. Companies developing supply chains across multiple regions increasingly utilize local currencies and regional trading arrangements rather than converting everything through dollar-dominated systems. This operational change reduces dollar transaction volumes while building experience with alternative currency systems. Technology sector development increasingly occurs outside traditional dollar-dominated venture capital and development finance systems. Chinese technology companies access domestic capital markets while developing international capabilities through yuan-denominated financing rather than dollar-based systems. This technology development pattern creates industrial capabilities that support alternative currency systems while reducing dependence on dollar-dominated finance. The insurance and reinsurance industry faces growing challenges from climate change, geopolitical risks, and financial system instability that encourage diversification away from concentrated dollar exposure. Major insurance companies increasingly utilize alternative currencies and precious metals for reserve management while reducing exposure to long-term dollar-denominated assets whose purchasing power faces systematic erosion risk. Pension fund and sovereign wealth fund behavior shows systematic movement toward alternative assets, including precious metals, commodities, and non-dollar currencies. These institutional investors manage trillions in assets with long-term investment horizons that require protection against currency devaluation and monetary system transition risks. Their allocation changes create sustained demand for dollar alternatives while reducing support for traditional dollar-denominated assets. Educational institution and research organization analysis increasingly recognizes monetary system transition as mathematical inevitability rather than speculative possibility. Academic research demonstrates historical patterns of reserve currency transitions while analyzing current indicators that suggest similar processes occurring currently. This academic recognition provides intellectual foundation for policy and institutional changes that support alternative system development. The psychological aspects of monetary system transitions typically involve extended periods where changes occur without widespread public recognition, followed by rapid awareness shifts when alternative systems reach critical adoption levels. Most people continue using familiar systems while alternatives develop, creating false impression of stability that persists until adoption reaches tipping points where network effects accelerate change dramatically. Consumer adoption of alternative payment systems for domestic commerce creates familiarity and trust that facilitates international usage when systems achieve operational capability. Chinese consumers' extensive use of digital payment systems provides foundation for international digital yuan adoption while reducing cultural barriers to alternative currency usage. Similar patterns develop in other countries implementing digital currency capabilities. The legal and regulatory framework development for alternative currency systems occurs gradually through pilot programs, bilateral agreements, and multilateral arrangements that establish operational precedents without requiring dramatic policy announcements. This incremental approach creates institutional capabilities while avoiding political resistance that might result from more confrontational implementation strategies. Regional security arrangements increasingly incorporate economic and monetary components that reduce dependence on dollar-dominated systems while building capabilities for crisis response. Security cooperation provides framework for deeper economic integration, including currency arrangements, trade settlement systems, and financial infrastructure development that supports alternative system adoption. International law development reflects growing recognition of monetary sovereignty as an essential component of national independence. Countries increasingly assert rights to utilize alternative currencies, payment systems, and reserve arrangements without external interference. This legal framework development supports alternative system adoption while reducing pressure for continued dollar system participation. The convergence of technological capability, mathematical necessity, and institutional preparation creates conditions where alternative monetary systems could rapidly expand during crisis conditions. Current infrastructure development establishes capabilities that remain secondary to dollar systems during stable conditions, but could quickly become primary systems if dollar system stress creates operational problems or political pressure for independence. This analysis examines observable developments rather than predicting specific outcomes or timing. Monetary system transitions represent complex processes involving technological, economic, political, and social factors that interact unpredictably. Understanding current developments provides context for evaluating global financial system evolution while maintaining perspective about the extended timeframes typically required for fundamental system changes. The transformation occurs quietly through incremental changes that build capabilities and experience necessary for more dramatic transitions when conditions become favorable for accelerated change.